Welcome to Stock Talks Deep Dive into Intuit. Intuit is a financial software platform best known for TurboTax, QuickBooks, and Credit Karma, tools used by tens of millions of consumers and small businesses to manage their taxes, accounting, and personal finances. At the time of recording, the stock is trading at $393.25, sitting near the lower end of its 52-week range, which stretches from 342 on the downside to 813 on the upside. The 50-day moving average stands at 415, while the 200-day moving average sits at 604, a significant gap that tells us the medium-term trend has been under meaningful pressure. The RSI, or Relative Strength Index, reads 44.5, squarely in neutral territory. Let us work through the fundamentals, scene by scene, starting with a quick business overview. Intuit operates a subscription-driven financial technology ecosystem. Its three flagship platforms, QuickBooks for small business accounting, TurboTax for consumer tax filing, and Credit Karma for personal finance and lending matchmaking, create a deeply embedded customer base with high switching costs. The company monetizes through software subscriptions, assisted tax preparation, and a growing financial services layer. The Stock Talk score for Intuit comes in at 64 out of 100, signaling a hold. Financial health scores a strong 17 out of 20, profitability matches at 17, growth earns 16, but valuation scores a weak 6 out of 20, and smart money registers 8, both of which we will unpack in detail. Now, valuation. The question every investor has to answer. Are you paying the right price? On a trailing price-to-earnings basis, Intuit trades at 25.47 times earnings, a multiple that in isolation looks reasonable for a high-quality software business. The forward price-to-earnings ratio, which uses consensus earnings estimates for the year ahead, drops sharply to 14.86 times. That compression signals that the market is pricing in meaningful earnings growth ahead. The PEG ratio, which normalizes the price-to-earnings multiple against the company's growth rate, stands at 1.06, suggesting the valuation is roughly in line with growth expectations rather than stretched. The EV to EBITDA multiple, a measure of enterprise value relative to operating cash generation, sits at 17.2 times. In our view, the competitive moat here is formidable. Intuit benefits from a combination of high switching costs. Small businesses rarely rip out their accounting software, and powerful network effects through Credit Karma's data-driven lending marketplace. The Guru Focus Value, an independent intrinsic value estimate, stands at $778.17, implying a margin of safety, meaning the discount to estimated fair value, of approximately 49% at the time of recording. That is a significant gap. Wall Street analysts, at the time of recording, have a consensus mean target of $600 across 32 analysts covering the name, with the high end reaching $916. The next earnings report is due May 21st of 2026, with the street expecting earnings per share of approximately $12.52. That represents a near-term catalyst worth monitoring. Market sentiment around Intuit, as of the creation of this video, leans neutral, with insufficient recent news flow to drive a directional read. Relative to software peers, which have historically traded at 20 to 30 times forward earnings, the forward multiple of 14.86 appears undemanding. In our view, the setup looks interesting from a valuation standpoint, though we would want to see earnings follow through to validate it. Moving to financial strength, how solid is the foundation? The Piotrowski F-score is a 9-point checklist of balance sheet, profitability, and operating efficiency signals, and Intuit scores a perfect 9 out of 9. That is a rare outcome and indicates broad-based fundamental strength across every dimension the model examines. The Altman Z-score, which estimates the statistical probability of financial distress, registers at 6.34. Any score above 3 is generally considered safe. 6.34 places Intuit firmly in the healthy zone, with no near-term solvency concerns in our view. On the debt side, the cash-to-debt ratio is 0.43, meaning the company holds 43 cents of cash for every dollar of debt. That is not a fortress balance sheet, but the context matters. The interest coverage ratio stands at 22.43 times, meaning the company generates operating income more than 22 times what it costs to service its debt. That is a high-quality credit profile by any measure. The current ratio, current assets divided by current liabilities, a measure of short-term liquidity, is 1.32, safely above the 1.0 threshold. Debt to equity is a modest 0.36, meaning the capital structure carries far more equity than debt. The verdict on financial strength. The foundation here is genuinely robust. Next up, profitability. Is this business actually making money efficiently? Let us start with ROIC, return on invested capital, which measures how effectively management deploys capital to generate earnings. Intuit's return on invested capital is 14.28%. For context, most high-quality software businesses aim to sustain return on invested capital consistently above the cost of capital, which is typically estimated somewhere in the 8 to 10% range. 14.28% clears that bar comfortably in our view. Now let us run the margin stack. Gross margin, the percentage of revenue remaining after direct costs, is 80%. That is an exceptional figure and reflects the near-zero marginal cost of delivering software at scale. Operating margin, which accounts for overhead and operating expenses, comes in at 27.09%. Net margin, the final bottom-line profitability after all costs including taxes and interest, is 21.57%. And free cash flow margin, the percentage of revenue that converts to actual cash after capital expenditures, is 33.99%. That free cash flow figure is particularly compelling. It means that for roughly every $3 of revenue Intuit collects, $1 converts to usable cash. ROE, or return on equity, is 22.57%, and return on assets is 12.56%. The profitability profile here is, in our view, among the strongest in the software sector. Onto growth. Is this business expanding? And at what rate? Over the trailing 3 years, Intuit has compounded revenue at 14% annually. Extending the window to 5 years, that figure rises to 17.8%. The fact that the 5-year rate exceeds the 3-year rate is worth noting. It could suggest some moderation in the pace of top-line expansion more recently, and that is something we would want to monitor as new data comes in. 17 to 18% compounded revenue growth over 5 years for a business generating 80% gross margins represents genuinely high-quality expansion. The company is not just growing for growth's sake. It is growing while maintaining the unit economics we examined in the previous scene. Book value per share, which measures the net accounting worth of the business on a per-share basis, has grown at 6.6% annually over 3 years. That is a more modest figure, and it reflects the company's capital return activity. Share buybacks and dividends both consume book value while benefiting shareholders through other channels. On that note, Intuit currently carries a dividend yield of 1.18%. That is not a yield that income investors would typically chase, but it does signal that management is returning cash to shareholders while continuing to invest in the platform. In our view, the growth story at Intuit is durable, driven by deepening penetration in small business accounting, continued consumer tax filing share, and the longer-term opportunity in AI-assisted financial services. Now let us talk smart money. What institutional capital is actually doing with this name? 14 top-tier guru investors currently hold positions in Intuit. That is a meaningful endorsement from the community of super investors whose portfolios are tracked through 13F filings, the quarterly disclosures that institutional managers above a certain asset threshold are required to file with regulators. However, the direction of that smart money is where we need to be careful. Looking at the 13F filing data, only 12.5% of institutional filers are net buyers at the time of recording. In smart money analysis, a reading above 50% would signal broadly bullish institutional conviction. 12.5% suggests the majority of institutions are either holding steady or reducing exposure. Let us look at specific holders. Linsell Train, a high-conviction quality investor, holds Intuit as 10.25% of its portfolio, but has reduced by a modest 0.25%. Terry Smith of Fundsmith, one of the most respected long-duration investors in the world, holds it at 2.42% of portfolio and has recently added 3.5%, which is a constructive signal. On the other side, Dennis Hong of Shaw Spring Partners has reduced a significant 55.65% of his position, and Jensen Investment Management has cut by 49.16%. These are substantial reductions that warrant attention. Insider ownership stands at just 0.55%. Management owns very little of the company relative to its size. In the most recent 3-month window, there were 0 insider purchases and 1 insider sale. Taken together, the smart money picture is mixed at best, and in our opinion warrants caution. And finally, the verdict. Let us bring it all together. On valuation, the data suggests that Intuit is trading at a meaningful discount to its Guru Focus intrinsic value estimate, with a forward earnings multiple well below historical software sector norms. In our view, the setup looks interesting, but we would want earnings delivery to confirm the thesis. On financial strength, the picture is as clean as it gets. A perfect Piotrowski score, a safe Altman Z-score, and interest coverage that leaves almost no room for concern. On profitability, 80% gross margins and a free cash flow margin approaching 34% place Intuit in the top tier of software businesses by any standard measure. On growth, trailing 5-year revenue expansion of nearly 18% is compelling, though some moderation in the 3-year window is worth watching. On smart money, the signal is the most mixed element of this analysis. Meaningful position reductions from several prominent investors and low institutional net buying participation add a layer of caution. The stock talk score of 64 out of 100 reflects this balance, a high-quality business under price pressure, with valuation optionality but meaningful uncertainty in the institutional posture. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Intuit. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.